Before watching the video, don't forget to subscribe the channel and enable bell notification to never miss an update from us.
Hello everyone, welcome back. So today we are going to discuss the second part of risks in banking sector. So last time we have already taken this topic and the risks that were pending are liquidity, equity and business risk. So we must understand what is it. So let's start with the topic. Now, type of risk in bank. As we already discussed, what is risk? Risk means happening of any unexpected event that could cause a disaster or catastrophic effect, isn't it? So we already discussed that how bank can collapse, what we sometimes say that they are on the edge of failure, that the investors are nail biting. We have already discussed all these things, and we also know that RBI is the regulatory body that is handling each and everything, because of which banks in India can function smoothly. Fine. So there is a mechanism of CRR and SLR which is maintained by RBI, and RBI sees each and everything so that everything goes in a smooth manner. Fine. So we have also discussed that there were different types of risk in the banking, which were credit, operational, market, interest, reputational and liquidity risk. So the topics which we have to discuss today are liquidity risk. Fine. Then we'll be discussing about equity risk, and then we'll be discussing about the business risk. So let's start with our first topic, that is liquidity risk. Now what is liquidity risk? Liquidity risk is the risk that a bank might not be able to meet its short-term financial demands or contractual obligations. Fine. Liquidity risk can also be viewed from a bank's inability to dispose of its holding in securities or other assets without suffering unacceptable losses either of capital or income during conversion process. Now there are different type of liquidity risk, that is it is in three forms. The first one is funding risk. What is funding risk? Funding liquidity risk is defined as the inability of to obtain funds to meet the cash flow obligations. For banks, funding liquidity risk is crucial. This arises from the need to replace net outflows due to unanticipated withdrawal, non-renewal of deposits. Fine. Talking about time risk arises from the need to compensate for non-receipt of expected inflow of funds, that is, performing assets turning into the non-performing assets. And if we talk about the call risk, what is it? Call risk arises due to crystallization of contingent liabilities. It may also arise when a bank may not be able to undertake profitable business opportunities when it arises. Fine. Now let's talk about the equity risk. Now what is equity risk? Equity risk is the financial risk which is involved in holding equity in a particular investment. Equity risk often refers to equity in companies through the purchase of stocks and does not commonly refer to the risk in paying into real estate or building equity in properties. The measure of risk used in equity markets is typically the standard deviation of the securities price over a number of periods. Now, the next risk is business risk. Now, this risk is the most common among all the risks. Now, what is business risk? See, business risk is the bank's inability to generate profits at its target level. Now, in this condition, bank is unable to generate profit at its target level, and it can happen with many conditions where I can give you an example. For example, there's a bank, let's say it's it's Bank of Baroda. Now, Bank of Baroda has given a loan to some company XYZ for 15 years. Now, since the loan is given for 15 years, we know that the principal amount will be returned along with the interest will be there, isn't it? So, total amount would include the principal and interest. Now, what happens? Since the loan was only for 15 years and the company is unable to generate profit, that is, we can say that company goes in the bankruptcy, or rather I can say it goes in the loss part. Now it's very simple thing to understand that if any of the company is in loss, that means the company will not be able to pay back the interest and the principal, isn't it? So now what will happen? The company that had to return amount after 15 years will not be able to pay the amount and interest back to the bank. Now this is the condition which we can say that this is what bank risk is. Sorry, business risk is. Fine. So this risk is also known as the business risk, and I have already given the example. Fine. So it is the most common amongst all the risks. So this was business risk. So we have already discussed all the three risks today. In case you have any doubt in any of the risk, please do comment so that I can help you out. Please like the video and share as much as possible. So thanking you for watching this video. Thanks a lot.